Chapter 10, Part 3, we're going to look at capitalized interest for construction projects for property, plant, and equipment. Now, capitalized costs include all costs associated with getting the tangible asset ready for its intended purpose, and this includes interest. So, a company might decide to construct an asset for its own use rather than buy an existing one. So, two critical issues is determining the amount of indirect manufacturing cost overhead to allocate and deciding on the proper treatment of interest, how much of it should be capitalized. So overhead allocation, we're not going to worry about that. We have the inclusion of only incremental overhead or the full cost, or we can capitalize and then allocate as depreciated, which would be our capitalized interest. And this is what we're going to be covering in this part. Now, there are three approaches. One is you don't capitalize any of the interest on any of the loans that are outstanding or any loan that you made just for the project. Second way, which is GAAP, is you capitalize the actual interest with modification. And third, you capitalize all interest during the period. So, rules for capitalized interest. Capitalization begins when expenditures are made and interest is being accrued, and it ends when the project is complete and ready for use. The amount of the interest to be capitalized is either the actual interest or the avoidable interest, whichever is less. So we have an example where we are financing the construction of a new building. We borrowed $1 million at 12% for the building. And we also, during the year, we spent $360,000 on March 1st, $600,000 on June 1st, July 1st, 1.5, and December 1st, $1.5 million. And the building was completed in 2026. Now, we also have these two outstanding loans. So now we're going to determine the interest we have to capitalize. So first, let's take a look at what do we need. Well, we need to know how much was unique to the construction project, and that was $1 million at 12%. We know that we started spending in March, and then in June and July and December. And we also know we have those other two loans outstanding. So let's take a look at our expenditures and how long they were outstanding, because we need to get a weighted average for our expenditures. So first of all, the $360,000 expenditure would have been over 10 months because it was on March 1st. On June 1st, it would be 7 months over 12. July 1st, it would be 6. December 1st, it would be 1. So we have average weighted expenditures of $1,525,000. Now, let's take a look. We have our current construction loan, which is $1 million at 12%. So the annual interest is $120,000. And we have our other loans, which total $600,000. So we have total actual interest for 2025 of $720,000. Now, we are not going to capitalize all that interest because we have a rule. First of all, what we need to do is you're going to capitalize whichever is less, the amount unique to the project or all the interest. So in this example right here, what we're going to do is we're going to take our other loan interest and divide by the other loan amount to come up with a weighted average interest for the other loans. Now we're going to determine the avoidable interest, or the interest we wouldn't have paid if we hadn't started this construction project, maybe. So we had weighted expenditures of $1,525,000. We back out our construction loan. And now we have to apply interest for the balance of $525,000, which means we have total avoidable interest, which is the interest we should capitalize, of $176,228. But first, we have to make our comparison, whichever is lower, the actual interest or the avoidable interest, which is less, so that's what we're going to capitalize when we do our journal entry. So the building is going to get $176,228 of the interest. The balance is going to be interest expense. And that ends this presentation.